So, you want to be a real estate investor, but where do you start? How do you know what information and sources to trust? That's where I come in. I'm Jonny Cattani, and this is the Investor Relations Real Estate Podcast. Hey guys, real quick, before we start, go to investwithcattani.com and download my free ebook, Is Commercial Real Estate Recession Proof? Now to today's show. What's up, guys, and welcome to another episode of the Investor Relations Real Estate Podcast. I'm your host, Jonny Cattani, and I'm joined today by John Rubino. John is the COO, founder, and co-managing partner of JIDI Investments, LLC. JIDI is a real estate, private money, and equity investment firm which seeks to secure high-yield returns with medium risk by providing investment capital to individuals and businesses with variable residential, commercial, and mixed-use real estate business and/or investment opportunities. John's primary responsibilities include executing the daily operations of JIDI to include marketing and advertisement, website and social media design, investor and client relations, extensive due diligence review of all prospective investor and business clients, financial and revenue analysis, and securing of investment sources for project funding, resulting in investments of over $28.2 million for the company. JIDI has over $19 million invested in 10 executing projects in several thriving real estate markets: Washington, D.C., Frederick, Maryland, Richmond, Virginia, Fairfax, Virginia, Charlotte, North Carolina, and Atlanta, Georgia. John is a graduate of New York Maritime College and holds a third mate's license in the U.S. Merchant Marine. After graduation, he received a commission as a U.S. naval officer. He served honorably as a naval aviator for 20 years. In 2008, he received his Master of Science from Embry-Riddle Aeronautical University. John, thanks so much for coming on.
Thanks, Jonathan. I appreciate it. That was good. You did that really well. No pauses or nothing.
I practiced.
Awesome. Very cool. Nice job.
Thank you. So we obviously discussed a little bit offline there for a bit. I am admittedly a closet nerd for aviation, and you flew an airplane that's familiar to me, the P-3 Orion. So that's really awesome. So let's kind of jump all the way back. You obviously started as a naval aviator. So kind of talk about your career in the Navy and how that led to where you're at now.
Yeah, so I'm born and raised in Brooklyn, New York. My dad was a Marine, served in Korea. When I was a kid, I always thought being in the military was the coolest thing in the world. And it was reinforced when the movie Top Gun came out. And so when I saw that movie and knew what my dad did, I said, this is for me. So I went to high school. I went to a junior ROTC high school. So I was kind of like, running around as a military kid in high school. And then in college, I went to a college that had a ROTC for the Navy, graduated, like you said, with a commission, my degree, and my third mate's license in the Merchant Marine. Went off to aviation pilot indoctrination down in Pensacola, Florida for 6 weeks to learn how to swim with all your gear on and learn all that good stuff and take some classes I've never even thought I would before, like aerodynamics and meteorology. And so that was cool. And then I learned how to fly airplanes down in Corpus Christi, Texas for 2 years. Then got my wings in 1999. And then I went to Jacksonville, Florida, and I was in Jacksonville for 4 years, flying the P-3, like you said. Good job. You got that one straight off when you saw the picture, which is pretty cool. And I served 20 years flying the P-3. I did a couple of staff jobs in Naples, Italy, and I had my last tour here back in Washington, D.C., right outside the Pentagon, serving on the Navy headquarters staff, which was pretty cool. And I learned a ton. But I really did enjoy that time flying the airplane. I got a chance to also fly as an instructor pilot, teaching kids coming out of college how to fly, which was really neat. So that was a lot of fun, and I enjoyed my 20 years. I guess I got my feet wet in real estate about halfway through my career in the Navy in 2010. I was stationed down in Patuxent River, Maryland, right outside of NAS Naval Air Station, Patuxent River, Maryland. And I was there with my wife and a newborn and then one on the way. And we lived in a really good area that was starting to grow due to the increased employment of folks that were supporting the base. And so there was a lot of people coming into that area, mainly due to government contracting, defense jobs, and things that were needed to support the base. So we saw there the opportunity to jump in and get involved in the market. I really didn't know much about real estate until a good friend of mine who I still work with today introduced it to me on an 8-week trip when we were out in New Orleans. We were testing some gear for the Naval Research Lab when I was stationed there. And I was in my room, I don't know, playing Nintendo or something. And he came in and he says, "Hey, why don't you stop goofing off and let me show you what I'm doing in this thing called real estate." I'm like, "All right." So I started listening, and the next thing you know, I was just hooked. I just wanted to do that and got into it. And he made it really exciting. And, you know, I just really thought it was the coolest thing since sliced bread. So when I got back from that trip, I started learning more, and I started trying to get into foreclosures and trying to buy fix and flips and try to get involved with people that were doing that stuff. But in that time, it was around 05, 06. You know, the market was kind of like it was pre-COVID, really hot. You know, a lot of things were going on with regards to people borrowing money more than they can pay back, and properties were totally overappreciated. And so I found a niche in new construction home building. And my buddy, he and I both found this builder that was about a half a mile away from where I lived. And for a $1,000 investment, we were actually able to partner with this builder who was building spec homes. And so we invested with him. He ended up holding the construction loan through CO and then certificate of occupancy, and then basically would switch over to us to take over the permanent financing with the construction loan. What I ended up doing is about 2 weeks before we turned over the loan, I actually found a buyer. And so I was all in on that investment for about $285K, which would have transferred over to me once the house closed, but I ended up selling it for around $365,000. So I netted out about $60,000, and I was like, "Wow, this is awesome." So I did that again in another property up north in Waldorf, Maryland, which is in Maryland, a little bit further where I was, and then I sold my primary residence and did really well on that. And so my buddy and I, he was kind of going this way and I was going that way. I was going to go overseas for 3 years with my family to serve in Naples, Italy. My buddy was getting out to start his company, so I gave him a non-collateralized loan. He was paying me 10% a year, and he's using that company, that capital, kind of to start his business to find properties. And I tell you, I wouldn't have had that money if it wasn't for him and all he taught me. And at the same time, getting into it, and he ended up doing so well now that he's a $400 million development company, and has done very well for himself. And so over the 10 years, from 10 years to 20 years, you know, that's where he was in his world. And my world, as I was continuing and knowing it was going to be a career with my family, and kind of going through the 20-year process. But when I got done down in Texas for my instructor pilot tour, I came back up here in DC around 2012. And after the first year at the Pentagon, I said, "You know what, I'm going to be retiring in about 5-6 years. You know, what do I want to do when I get out?" And I thought that this would be a great way to take what I've learned all through that time and turn that into a business. And that's exactly what I did. I partnered with my accountant, who's now our business CFO and one of my closest friends, if not my best friend. And he and I together put this business together. And basically what we did is what you would call syndication, but not as operators or active sponsors, more of going out and raising capital through friends and family to start, and bringing it in through our business and investing through a single purpose vehicle and entity into the project that the sponsor had as a part of what's called, as you know, Jonathan, limited partner or general partner equity. And so we started small. We started on some residential renovation projects, bringing in just private money. And then we started really elevating into where we knew we would be, which is that equity piece. And so we started on a $500,000 equity raise, then a $750,000, then a $1 million. The next thing you know, we're bringing in $1.5 million, $2 million, $3 million, $5 million, and we're investing on these very large scale 50, 100, 150, 200 unit condos or apartment units with some mixed use retail in some of the greatest markets that I feel on the East Coast are right now.
And is this all still new construction focused all through this?
Yeah, a lot of
process?
it's development, new construction, some condo conversions were what we were in as well. But most of it was ground up, new construction, development of the properties, getting them entitled, or they would already subject to or by right to come in and to build what the sponsors had in mind. And so we would, come in and help bring in that equity that they needed to complement the debt financing that they were getting from the banks. So we did that. We've been doing that, and that's been a really nice niche. And so we have the potential to go out to now about 175, 180 investors to raise anywhere from $500,000 to $5 million a project. We started working with a fantastic attorney who does our private placement memorandums. He files our 506B or C SEC documents, which is great. So we come in to these projects for the sponsors as an already, stood up entity with a private placement with a unregistered security through our business to allow the sponsor to get these chunks of capital where we manage, we're not managed, but we help oversee the capital from the investors at the $25,000 to $50,000 level to bring in that larger, 3 or 4 or 5 million into the deal. And my partner David and I, we invest on all the projects as well. And we also, go through a due diligence process with the sponsors, making sure they're investing in the projects and that, we oversee the project. We don't have any collateral on these deals. We don't have a lien position. We're not getting any type of personal guarantees, but we're not participating in recourse. We're not dealing with the banks personally. So that takes a lot of risk off of our shoulders and allows us the opportunity to be able to participate passively. And so for the sponsors, we're doing that service for them. For the investors, we're getting them these very nice returns. Typically on a new development or new construction deal, we're shooting to get the investors an accrued or deferred return on a pref at about 12%. Okay. And then if we hit our targeted returns after the waterfall progression, we're usually getting them around a 15 to 20% return.
Awesome. So that was going to be my next question then. Yeah. So that sounds like that's, and kind of you can go more into like your current investment thesis. That's basically, are you looking at return? Obviously sponsor, sounds like you specifically are really the one who's doing the due diligence. So kind of talk about your due diligence process and how that leads to, that thesis and getting those returns.
Yeah, so it starts with the companies that want to work with us, to make sure we go through and just get familiar with them and their team, their executives, how they do business, go through a few full cycle deals, hopefully meet them across the table instead of just on a phone call to make sure we go through that process. We also want to make sure that they understand what our requirements are and parameters are for our money so that they're on board. You don't want to look at a deal and find out, oh man, they're not even near our returns. Or they require capital calls. We don't participate in capital calls. They're not mandatory for us. So that's a lot of the upfront stuff. Plus we want to get good referrals. We want to make sure the deals make sense, that these guys don't have any red flags. And once we get through that, then we'll start looking at some of their deals and we'll put our team together. And we have a project consultant who does a lot of work for us part-time. And he used to be at Cushman, so he's fantastic. He goes through a lot of the deals and does a lot of that analysis at the project level for us to help. I'm the quarterback where I'm making sure communications is done right. We go through everything we need to do. We go through our checklist. We look at the big things, location, expertise from the experience from the sponsor. What are the fees? Does the information they're sending in their package match and look good? And then is it underwritten properly to what the market's showing? So that's what our due diligence consultant does. And then we also brought on an investor relations employee who's former Army, and he's a fantastic guy. He's been on board over a year already. It's crazy. And he's been a nice addition to basically manage a lot of the communications, information sharing with our investors. And we also hired him because we brought on Juniper Square, which is now our investment portal. It's a fantastic portal. And we use that for all of our communications and sharing of information and putting new offerings out to our investors and document storage and everything. And then the investors can go on and log on and see everything, totally sensitive information is all, secure. and they get their tax returns there. We do all that for them. My business partner is an enrolled agent, so he does all the tax returns and we upload everything. And so it's like a one-stop shop instead of having to do 25 different emails to one person. So yeah, it's a great business. Our focus really is growing the investor base, bringing on new investors that just want to be in a position to see what we're doing. And that's how we do it. We don't put anybody, we don't require people or obligate them to invest with us. We just want to have them on board if they're accredited and they meet the criteria and they're in a position to then see deals we've done and are doing. That's great. And then for sponsors, yeah, most of the sponsors we get now are people we know, people that connected us with good people. And that's what it's all about, is making sure you have a good fit with quality folks, not just, anybody for the sake of doing a deal.
Absolutely. And it sounds like you're in the referral phase, both on the investor side and on the sponsor side, which is obviously an incredible phase to be in, because now, you have that, that extra layer of, okay, this person can vouch for them. So when you're going in for your due diligence, that's already there. So kind of along those lines, since you guys do stay on that sort of passive side, talk about some of the red flags that, you guys look for or you see and are kind of your big no-nos, won't even do it, for people who are just getting into it as they're starting to vet their first sponsors and different things like that. What do those look like?
Yeah, I mean, I put together a checklist being a military guy, having things I look for, just review before we really start getting to know a sponsor and start, going on a few dates together. The big things I'm looking at is their experience. If you get a multifamily sponsor who says, "Hey, I'm doing my first, storage deal. I'd love for you to," no, we're not interested. Stay in your box. Robert Kiyosaki says, if you're making money and investing, it's pretty boring. He's right. And if you're bored, then don't invest anymore, do something else. But, that's the key is making sure that the sponsors have the right team, that they know the areas. That's another thing. I want to be in the markets I'm in because I know them. So I like DC, Maryland, Virginia, and the East Coast down to Florida, maybe as far west as Tennessee. And we love those markets because we know those markets are growing. There's population growth, there's jobs, it's good weather, low taxes, fiscally conservative. We like all that, right? And people do too. So we like those markets. So that's kind of, another check in the box. Again, if you're doing deals in a certain market and you're good at doing deals in a certain market, it's because you know the market and you know how to get through the bureaucracy of the market. So if you have to go and get permits, you have to deal with, design phase and everything. You want to be able to work with someone that's been through that market or at least knows the process. I'll give you an example. So like we worked with this group that we've worked with for a long time, and they're doing their first deal in Charlotte, North Carolina, which is a great market, but they've never done a deal there. But I know Charlotte's a good market. It's a market that there's not a lot of red tape from what we know. And so they can still get their process the way they do it as they've done it in DC or in Atlanta and get those projects through. Now, if it was a brand new sponsor in a brand new market, that may give me a little bit of a concern, especially if they're asking me, "Oh yeah, we want you to bring in $5 million, and this is kind of our first deal in this market." And we never did this type of asset class before. So it's, that's the Swiss cheese model, right? That ain't gonna work. New developer in a hot market, maybe what we try to do is say, well, who's your co-GP? Who are you bringing on with you that's got the expertise, right? That's a question that could help maybe alleviate or mitigate a little of that risk. If it's out in California, I don't care how good you are, we're just not investing in California right now. So that's another one that would just come off the list. But yeah, the top 5 I would say is, experience, location, good returns, good track record, and then just, from initial due diligence on them, there's no red flags, any fraud or issues or anything. We go online, we find they're clean business, they're good. Then we'll start going into a little bit more detail, start asking for referrals, talk to the bank, maybe look through some more deals and making sure they're a good fit for us. We're in no rush in our process. We don't try to, accelerate things. We have a nice full of projects that we're investing in right now with 10 deals, and we're getting deals going through where they're finishing and most of them are in construction or finishing up. So there's a nice progression. We're not really pressured to have to go out and do another set of deals. We're probably pretty good for the next 5-6 years, but of course, we want to look at other businesses as well.
Absolutely.
Yeah.
So what I hear you saying is that you're willing to forego certain things for other metrics as long as, the main ones are met, like you said. already know the sponsor, already know their track record, willing to go into a new market that you guys know with them because they've already proven other aspects of your guys' checklist. So that's a big thing as well, is that you don't always have to have, this is it, these are the only things we stick to, as long as, the other things kind of check out, as you mentioned. So, with the current landscape, obviously a lot of, you guys are in the kind of the construction and everything. What are you seeing with prices and now, interest rates going up? What are you kind of seeing return? Are you seeing returns starting to shrink yet, or are you still finding those deals in those markets because they're so good with the cost of goods and labor and that?
Yeah, that's a great question. I mean, obviously, COVID, supply chain, inflation, it's all playing a big part of the changes to the landscape of deals now and the way they're underwritten. A lot of our sponsors are throwing on an extra 5 to 10% on the contingencies. They're really trying their best to get as much of a guaranteed maximum price bid contract, the GMP, as best as possible. Yeah, a lot of them are trying to do things in a way creatively to make the deals work. But again, yeah, you got to be careful. You just got to make sure that they're not cutting corners or anything. Interest rates, a lot of our sponsors were getting 2.25 to 2.5. Now we're seeing them underwrite to 3.5 to 4, just to be safe. And LTVs as low as 60 to 55%, LTV, LTC, which is good. And yeah, just, having the flexibility on cost, just because of the fact that, we don't know that the supply chain could continue to wreak havoc, and inflation, that prices and goods are going to go up, and labor market issues. And, COVID could have another wave this fall or summer. So yeah, these are all the things we're looking at. We're asking our team, okay, everything looks good on paper, but what if this happens and we get a 20% drop in expected occupancy, or vacancies go up, from 5 to 15%, where's our break even? Where's some of the places we need to make? But no, I think we're also seeing too that some sponsors are being generous in a way to say, hey, if we don't hit these hurdles, I'm willing to share a little bit of my promote to help get there if I need. So again, we don't want that to be the standard, just maybe it's the exception, not the norm, I should say. So that's something that sponsors are doing too, because they want to do deals. They want to continue to get the ball moving with their businesses growing, but yeah, they definitely want to be very conservative still. And so do we. We want them to underwrite a triple on a home run, and if we hit a double or maybe even a single, so be it. We didn't lose any money, but we still got a pretty good return.
Absolutely. So with these new construction, obviously, your investors are aware of, what the deal looks like, but kind of break down the structure of this deal. Kind of start to finish, when they can expect to start seeing returns, and
sure,
and how that looks.
Yeah, I mean, so you're always going to have a longer edge timeline when you get into a development and new construction deal. If you're staying in from development all the way to some sort of closeout, whether it's a refinance or a sale or some sort of liquidation or buyout of your shares of ownership. So yeah, they usually have the timelines at between 18 to 48 months, let's say, is a typical timeline. We may even see some that go out to 60 months, just depends. And so, it's definitely a fluid movement in those deals, because there's so many things that have to get done. And so in order to get those really, really nice returns for our investors and for our company, we do have to be a little more, semper gumby, we call it in the military, flexible with the fact that there could be delays due to weather or due to labor issues, or due to the fact that permitting offices may be closed due to COVID outbreak. So, but the goal there is to make sure that even if there are changes in the timeline, that we still try to capture those returns, even if they go out further out. So, if we're telling investors, hey, we're shooting for 17% return a year on your money over, let's say, a 4-year period, and we're delayed an extra year, we try to still hold that 17, but if it's down to 15 or 15 and a half or 14 even, that's okay. It's not as great as it was going to be, but they're getting an extra pile of money on the extended timeline. Plus our pref at usually 12% is really protecting them, because the way we set it up is that if the investors don't make the first 12% of distributable profit, the company doesn't get paid. So that first 12% gives them comfort at night and lets them sleep better, knowing that, hey, if God forbid, we don't hit at least 12%, the investors are getting all of the returns. And that's just something that my partner and I agree to, and that's what we stand by. And a lot of sponsors we work with do the same thing. They pay us first before they take a promote because of what's happened with COVID. And if the deal doesn't go as expected, and those are the things you want to ask, and you want to make sure you have those types of relationships before you start doing deals together.
Absolutely. And then ultimately it just comes down to being very transparent with your investors and open communication and setting the expectation. And, if something changes, which obviously, as we're seeing, things are changing almost daily right now. So, just keeping that open communication with your investors and keeping them in the loop, so to speak. You really, at that point, they're going to stay loyal. And it sounds like you probably have investors who are with you, all along the way.
Yeah. And we are very transparent, and we're very consistent. We typically go out quarterly with project updates that come from the sponsor that we share with the investors. We're always available, obviously, if somebody reaches out for a call or an email. I try to meet with the investors that are local, at least as much as I can, to take them out to projects when we can get them out to properties. So yeah, just making sure that that's part of your job. It's part of what I do, and part of what my role is in the business.
Absolutely. So what do you see, I guess, with the current landscape, with the way, you guys have obviously been in this construction industry for a long time in terms of new development. So do you have an idea, obviously things are hard to predict, but do you have an idea of where things are headed in terms of, let's just say, the supply chain? Do you see it getting better in the near future, or are we still kind of headed in the same bottleneck direction?
I think it's going to be challenging, mostly due to the political landscape. That's what I kind of see. And I try not to get into that too much, but I think it's just a fact of life, is that we just have, not even national, but globally, it's just constant, friction. And I think that is going to continue to at least have some sort of an impact on the economy, economies of scale across the world. I still believe that, the United States is the greatest country in the world. We're a capitalist nation. We thrive on business, no matter how much you hear about how people want to tax the corporate sides higher and the rich. We're still going to be, way above what's going on in the rest of the world. But at the same time, you have to look at your specific areas and see what, you're going to have to deal with there. So if that's the case, you just gotta see what your specific area is going to be impacted by. And then you have to see also, how does that impact my specific markets? Because, there's a lot of markets that are still doing very well, and some that are not doing very well. Like, Chicago is struggling. DC is doing okay, but definitely got hit hard with COVID due to commercial and everything. So I think you really just have to take a step back and say, what's going on in my markets? And do I need to take a pause based on what's going on? Or do I need to, continue to just be patient, let things play out, and then, kind of then take a step back in and throw my hat in to see how it looks. So I think that's kind of how you got to look at it.
Absolutely. And being fluid and being able to realize, hey, what, maybe we do need to take a step back from this particular market. So kind of along those lines, what it is about these markets that are very attractive to you and keep you guys, so to stay there?
Yeah, so I go back to the standard foundations. Are people there? Is there a demand over a supply of housing? What are the businesses they're doing? Are there more businesses coming? Do people like warmer weather? People like places that are economically friendly. So that's why we love Atlanta. That's why we love, DC. That's why we love Charlotte. That's why we love the Carolinas, Florida, because those markets are just continually seeing that type of growth and that type of attraction. And that's why generally those are the foundations we typically want to shoot to look for. Definitely.
Awesome. Makes total sense. Cool. Well, we're nearing the end here. I would love to keep picking your brain. You're obviously very knowledgeable, and I've been doing this for a while, which I appreciate very much. So we'll jump in now. I have the 5 final questions that I ask all of my guests. The first one here is the best advice you've gotten from a mentor.
Oh, wow. The best advice I got from a mentor is have a mentor, and just be a sponge and learn and never take things for granted. Just to try your best to reach out to those people in your network that have the expertise, the mindset, have a good reputation that people know that they can count on you or you can count on them if you have questions. And yeah, just you're always going to be learning. Every deal you're going to learn something new. So
absolutely, I love that. That's awesome. So what is it about this career that makes you feel like you're fulfilling your why?
Yeah, that's a good one too. I mean, so I feel my why is I love people. I love being around people, whether it's a church or my neighborhood or whether it's just being around people in business that are doing something new and exciting. You get in front of people daily that are doing different, unique, exciting things. You get to share what you're doing. And I think that kind of is your why, because, you show a genuine attraction to the fact that you want to know more about those people that you're around. And if you're doing the right things, they're going to want to know about what you're doing and want to be around you. And I think that is a huge, not only humility wise, but just from a standpoint of just a compliment that, when people reach out to you and say, I love talking to you because you seem like you understand this and I appreciate your time. That means a lot to me because I see people appreciate that. And also when I reach out, I'm also very, very receptive and thankful to them as well.
Awesome. I love that. Cool. So what is your favorite non-real estate or investment related book?
So I just started reading a book called Atomic Habits, and a lot of people are raving about it. And
love that book.
It's a good book. It definitely, you probably know, it just talks to you about making subtle and small changes each day. And then I also started reading a book called what's it called? I can't remember the name of it, but it's all about mindfulness and basically being in the present moment and just trying to, take a deep breath, let it out. Things will pass, even though if it's really, 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 really busy, there is going to be a light at the end of the tunnel and there could be a downtime. But complacency is never a solution. But, at the same time, it's okay to take a break every day, go for a walk, get out of, the hustle and bustle of the business and just go for a walk with the dog or go for a run or just take your wife to lunch, surprise her or something just to break the monotony up.
Absolutely. That's awesome. Yeah. Atomic Habits. I've actually read it twice now. It's nice. It's a really, really great book for sure. He really nailed it. So I may already know the answer to this, but if you could have any superpower, what would it be?
Oh man, you said, I don't know. I guess be back in the airplane again and be able to fly every airplane, just like the Matrix, like the Trinity used to tell Locke or whatever, teach me how to fly a helicopter. And my daddy was flying a helicopter. So that would be pretty cool to be able to fly.
I was going to say, if it wasn't something related to flying, then that would have come out of left field, but we'd accept it for sure. Cool. Last one. What's the best way for people to get a hold of you and reach out for more information?
Absolutely. We have a great website, JIDIinvestments.com, if you want to share in your notes and get out to your folks. We're on LinkedIn. We got a great LinkedIn page, about 550 followers. I usually put pictures on there of our projects. I share some cool articles. Facebook, we got a YouTube channel, so I'm sure this will go on there as well if you're cool with that. And my email is just my first initial last name at JIDIinvestments.com. So please share that. And if people have questions, they want to ask me anything I got as far as something they're doing, I'm happy to help.
Sweet. Absolutely. Yeah. We will link all of that in the show notes, including the books and everything. So we'll make it really easy to reach out. John, thank you so much for coming on. I've really enjoyed it.
Thank you, Jonathan. I really appreciate it. And Italian power, we're strong. I appreciate it, man.
Absolutely. Hey guys, thank you so much for watching today's episode. I hope you really enjoyed it. Listen, I know it's cliche and you hear it all the time, but please don't forget to like and subscribe to the channel so you know when the next video is coming out. Even though this is technically a daily podcast, it's coming out the next day. We have a ton of content coming your way. So please like and subscribe. It helps a ton. Leave comments. Would love to know what you guys think. And we will see you on the next one. Thanks so much.